97% of Americans are leaving real money on the table every single month. The FDIC reports the national average savings rate as of 2026 is 0.42% APY. Meanwhile, top high-yield savings accounts pay over 4.5%. On a $25,000 balance, that is the difference between earning $105 per year versus over $1,125 per year, just for moving money. Today, we break down exactly where to park your cash for maximum return without taking on stock market risk. 3 categories of cash equivalent vehicles compete for your money: high-yield savings accounts, certificates of deposit, and money market funds. Each has different mechanics, tax treatment, and use cases. Picking the wrong one for your situation can cost you thousands per year and create headaches at tax time. Let me explain each one clearly without the marketing fluff that banks throw at you. High-yield savings accounts first. An HYSA is a federally insured deposit account at a bank or credit union, just like checking, but with higher interest. FDIC coverage protects up to $250,000 per depositor per institution. The rate is variable and adjusts with the Federal Reserve target rate. As of early 2026, the Fed funds rate sits at 4.25 to 4.5%, and competitive HYSAs from Marcus by Goldman Sachs, Ally Bank, and Discover Bank pay between 4.1 and 4.6%. The biggest advantage of HYSA is liquidity. You can withdraw funds in 1 to 3 business days via ACH transfer with no penalties. Some banks now offer instant transfers between accounts. There is no minimum holding period, no maturity date, no surrender charges. This is why HYSA is the universal recommendation for emergency funds and short-term savings goals like a down payment within 2 years. The disadvantages of HYSA. The rate is not locked. If the Federal Reserve cuts rates by 1% next year, your HYSA yield drops within weeks. Many banks impose a 6 withdrawal per month limit under Regulation D, although the Federal Reserve technically suspended this in 2020. Some banks impose minimum balance requirements or charge fees. Interest is taxed as ordinary income at federal and state level. For a high earner in California, that effective tax rate can exceed 45%. Certificates of deposit are next. A CD locks your money with a bank for a fixed term in exchange for a guaranteed rate. CDs are also FDIC insured up to $250,000. Terms range from 3 months to 5 years. The longer the term, the higher the rate usually. As of February 2026, top 12-month CD rates from Synchrony, Marcus, and Live Oak Bank sit between 4.3 and 4.7%. 5-year CD rates are between 4.0 and 4.4%, reflecting market expectations of falling rates. The CD advantage is rate certainty. If you believe interest rates will fall, locking in 4.5% for 5 years could protect future income. CDs are also disciplined savings tools. The early withdrawal penalty creates friction that stops you from rating the account. Federal rules require minimum penalties of 7 days of interest for short-term CDs, and many banks charge 3 to 12 months of interest for early breakage of longer terms. The CD disadvantage is illiquidity and opportunity cost. If rates rise after you lock in, you are stuck at the lower rate. If you need the money before maturity, you pay penalties that can wipe out months of interest. In an emergency, CD funds are essentially unavailable. CDs make no sense for the actual emergency fund because of this. They work for known future expenses like a tuition payment in 18 months. The CD ladder strategy solves the liquidity problem. Instead of putting $50,000 in one 5-year CD, you split it into 5 CDs of $10,000 each with maturities at 1, 2, 3, 4, and 5 years. As each CD matures, you reinvest in a new 5-year CD. After 5 years, you have 5 CDs all earning the long-term rate with one maturing every year, providing rolling access to cash. Susie Orman has recommended the CD ladder for decades for conservative retirees. Money market funds are the third option and the most misunderstood. A money market mutual fund is not the same as a money market deposit account at a bank. A money market fund is a SEC-registered mutual fund that invests in very short-term debt like treasury bills, commercial paper, and repurchase agreements. They are not FDIC insured, but they are SIPC protected when held at a brokerage. Top money market funds at Vanguard, Fidelity, and Schwab currently yield between 4.6 and 5.1%. Vanguard Federal Money Market Fund, ticker VMFXX, is the default settlement fund for Vanguard brokerage accounts and currently yields around 4.95% SEC 7-day yield as of February 2026. Fidelity Government Money Market Fund, ticker SPAX, yields similar levels. Schwab Value Advantage Money Fund, ticker SWVXX, often runs slightly higher. These funds invest primarily in U.S. Treasury securities, which makes part of the income exempt from state and local taxes in most states. Here is the tax advantage almost nobody calculates. If you live in California, New York, or Massachusetts and you hold a Treasury-heavy money market fund, the federal interest is still taxed, but the portion attributable to U.S. government securities is exempt from state tax. A California resident in the top bracket can save an additional 1.5% effective yield versus an HYSA paying the same nominal rate. For New York City residents, the savings are even larger when you stack city, state, and federal taxes. Money market funds versus HYSA on yield. As of 2026, money market funds consistently beat HYSAs by 30 to 80 basis points because they avoid the bank deposit insurance overhead and they pass through Treasury yields more directly. On $100,000, that yield difference is between $300 and $800 per year. For larger balances, money market funds at brokerages also blow past the $250,000 FDIC limit problem. Money market fund disadvantages. They are not federally insured, although the risk is extremely low for prime government money market funds. Settlement on withdrawals is T+1 in most cases, meaning you sell today and the cash arrives tomorrow. Some brokerages have minimum investment thresholds, although Vanguard, Fidelity, and Schwab now offer fund access with no minimums. You cannot use the money market fund as a direct payment method. You must transfer to a checking account first. The Treasury bills option deserves a mention. T-bills are short-term debt issued by the U.S. government with maturities from 4 weeks to 52 weeks. You can buy them directly through Treasury Direct with no fees or through a brokerage. As of February 2026, 4-week T-bills yield 4.7% and 52-week T-bills yield 4.3%. T-bill interest is exempt from state and local tax. You can build a T-bill ladder similar to a CD ladder for slightly better tax efficiency than CDs in high-tax states. The right choice depends on your situation. For the emergency fund itself, use HYSA. The instant liquidity matters more than the small yield difference. The Marcus by Goldman Sachs HYSA is a strong default because the platform is simple, has no minimum, and the rate has consistently tracked the top of the market. Ally Bank is similar with better customer service. For known short-term expenses 6 to 24 months out, use CDs or short Treasury bills. A wedding payment in 14 months. A planned home renovation in 18 months. A car purchase in 9 months. Lock in the rate, get the discipline benefit, and avoid the temptation to spend the money for something else. Match the CD maturity to your spending date. For excess cash beyond the emergency fund, money market funds at your existing brokerage are the cleanest choice. The yield advantage compounds. The state tax savings on Treasury funds are substantial. The settlement is fast enough for most needs. If you already have a Vanguard, Fidelity, or Schwab account, switching idle cash from your bank to the brokerage money market is the single highest return per minute decision you can make this year. Common mistake number 1. Chasing introductory rates that expire. Some banks advertise 5% for 3 months and then drop to 1%. Always check the standard ongoing rate, not the promotional teaser. The Truth in Savings Act requires banks to disclose the APY and any rate change conditions. Read the fine print before you transfer $50,000. Common mistake number 2. Keeping money in the same big bank just because of inertia. Chase, Wells Fargo, and Bank of America savings accounts pay around 0.01% in 2026. On $30,000, that is $3 per year. Moving to a 4.5% HYSA is $1,350 per year. The 15 minutes to open a new online account is the highest paid 15 minutes of work most Americans will ever do. Common mistake number 3. Spreading cash across too many accounts for FDIC protection that you do not need. If you have less than $250,000 in cash, you do not need multiple banks for insurance reasons. You might want 2 banks for redundancy in case one has a tech outage, but managing 5 different HYSAs to chase a 0.1% yield difference is a waste of time and creates tax reporting complications. Common mistake number 4. Ignoring the 1099 INT tax forms. Every account that pays you over $10 in interest generates a 1099 INT that the IRS sees. Underreporting interest income is a common automated audit trigger. Keep records of which institutions hold your cash and check your tax software shows all the 1099s before filing. The hidden Roth IRA cash trap. If you contribute to a Roth IRA at Vanguard or Fidelity and forget to invest the contribution, it sits in the settlement money market by default. That is fine for the yield because VMFXX and SPACs pay competitive rates. But many people accidentally leave Roth IRA contributions in cash for years thinking they bought an index fund. Check your Roth IRA holdings annually. Cash in a Roth IRA is wasting the most valuable tax shelter the U.S. tax code offers. The yield curve flattening signal for 2026. As of February 2026, the 4-week Treasury bill yields more than the 5-year Treasury note. This is called an inverted yield curve, and it has historically preceded most U.S. recessions. The implication for your cash strategy is to favor short duration. Do not lock into 5-year CDs at 4% when 12-month CDs pay 4.5% and short money market funds pay 4.95%. Stay short until the curve normalizes. But here is what nobody talks about. The biggest threat to your cash is not low interest rates. It is inflation. The Bureau of Labor Statistics CPI report for January 2026 shows headline inflation at 3.1% year over year. If your cash is earning 4.5% and inflation is 3.1%, your real return is 1.4%. Better than zero, but not wealth building. Cash is a defensive asset. The growth comes from stocks, real estate, and businesses. Do not confuse safety with prosperity. Your action plan. Step 1. Open a HYSA at Marcus, Ally, or Discover this week if you do not have one. Step 2. Calculate your emergency fund target from our previous video and move that amount to the HYSA. Step 3. For excess cash beyond the emergency fund, open a brokerage account at Vanguard, Fidelity, or Schwab and use the money market fund. Step 4. For known expenses 12 to 36 months out, build a small CD or T-bill ladder. Next video, we tackle Roth IRA limits and strategy for 2026. The contribution rules just changed and it matters for everyone earning under $250K.